Why did my mortgage payment go up? Escrow and property taxes explained.
It's the Mortgage 101 podcast where real talk meets home and life.
You have a fixed rate mortgage. Your interest rate didn't change. Your loan didn't change. You didn't refinance. So why did your payment just jump up by $130 a month? This catches Wisconsin homeowners off guard every single year. The good news is, once you understand the math, it's not nearly as scary as it looks. Howdy, folks. Welcome back to the Manley's Mortgage Minutes, powered by the Mortgage 101 podcast. I'm Manley Haines, and every week we cut through the noise and help you understand what is actually happening with your mortgage. Today, we're answering one of the most common questions I hear. Manley, I have a fixed rate mortgage. Why did my payment go up? Well, let's break it down. Here's the first thing you need to understand. A fixed rate mortgage does not mean your entire monthly payment is fixed forever. Your principal and interest payment is fixed. That's the portion that doesn't move. But most homeowners also have property taxes and homeowners insurance built into their payment. Those dollars go into an escrow account. Think of that escrow account as a holding bucket or a savings account. Every single month, you contribute a portion of your annual taxes and insurance, so when those bills come due, your lender pays them from that account. Simple enough until the tax bill changes. All right, let's make this real. Say you purchased a $425,000 home in Waukesha County. All right, so when you close, the annual property tax bill was $6,800. Divide that by 12 months, and now you're putting roughly $567 per month into that escrow bucket for taxes. Now let's say that property is reassessed and the new bill comes in at $7,600. That's an $800 annual increase. Here's the part that catches people off guard. That $800 increase can affect your payment in two ways at the same time. First, your escrow account may have a shortage because it was collecting money based on the old tax bill. Second, your lender now has to collect enough money going forward to cover the new tax bill. Here's the math. The $800 shortage gets spread over 12 months, so that's approximately $67 per month. Then your regular monthly tax escrow increases from about $567 to $633. That's another $66 per month. Add those together and your payment increases by about $133 a month. Your interest rate didn't move an inch. The increase came from your escrow account. Now here's the good news. After you catch up on the shortage, that temporary $67 portion should fall off. Your payment may settle back down the following year, but it will likely settle in at a higher amount than where you started because tax bills themselves are still going higher. And that is the big ticket item. Part of your payment increase may be temporary, but part of it may be permanent. You need to understand the difference. So, what's the move? First, when you buy a home in Wisconsin, do not build your budget only around the seller's old tax bill. Give yourself a little cushion. Second, when your escrow analysis arrives, read it. It will show you whether your taxes changed, whether your insurance changed, and whether you're going to have a shortage. Third, you may want to have the option to pay the shortage in one lump sum instead of spreading it over 12 months. That will not eliminate the higher tax bill, but it may reduce the temporary monthly spike. So here's the bottom line. A fixed rate mortgage locks in your interest rate. It doesn't lock in your property taxes, and it certainly doesn't lock in your homeowner's insurance. It does not guarantee that your total payment stays exactly the same forever. The fix is not to panic. The fix is to understand the numbers and prepare ahead of time. Thanks for watching this week's Manley's Mortgage Minutes, and check out the Mortgage 101 podcast where every Wednesday, Anthony and I break down what's happening in the market right now and how to move forward in confidence. I'm Manley, thanks a bunch, and I'll see you next week.